Ladies and gentlemen, good day and welcome to the Ujjivan Small Finance Bank Limited Q2FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Now, I hand over the conference over to Mr. Pritesh Bam. Thank you and over to you.
I welcome you all to Q2FY26 earnings call of Ujjivan Small Finance Bank. Today we have with us Mr. Sanjeev Nautiyal, MD and CEO, and the whole senior management team of the bank. I would like to thank the management for giving us the opportunity to host this call, and on that note, I would like to hand over the call to Mr. Nautiyal for his opening remarks. Over to you, sir.
Thank you, Pritesh. Good evening and welcome to our Q2 and first half financial year 26 earnings call. I'm happy to walk you through the business and financial performance of the bank for the mentioned period. Please note, references will be made to Q226 versus Q225 as YOY and Q126 as QOQ, along with a comparison of H126 against H125. India has remained the fastest growing major economy, recording real GDP growth for Q126 at 7.8%, coming ahead of consensus estimates of 6.7%. In the recent MPC, RBI has upgraded GDP growth estimates for Q2 and FY26 to 7% and 6.8% respectively, while lowering their FY26 inflation forecast to 2.6% from 3.1%. This was done in continuation of a neutral stance in monetary policy. This broad-based growth and recent policy actions like repo rate cut, GST rationalization, and tax cuts bode well for the economy's outlook, external headwinds notwithstanding. The RBI's MPC has introduced a glide path for the transition to the ECL framework. While this is not applicable to SFBs, we have studied the details and remain watchful to any future implications. A change has been proposed through the risk-based deposit insurance framework. We will share any implications once the notification is issued. Coming to the overall business, we have delivered a well-calibrated growth for the quarter by ensuring absorption of excess liquidity, thereby taking our CD ratio to 88%. Total deposits rose 1.5% QOQ, up 15.1% YOY at rupees 39,211 crores. CASA grew 14.9% QOQ and 22.1% YOY to rupees 10,783 crores, crossing 10,000 crore for the first time, while retail TD plus CASA deposits remained around 71% of our total deposits. Our CASA augmentation efforts are beginning to take shape. The MF distribution would be rolled out to customers in Q326. Incremental rollouts of ASBA and Forex will further drive CASA mobilization. We have proactively reset rates in both TD and SA in various buckets, resulting in improvement of cost of funds by 23 basis points QOQ and 17 basis points YOY. As you are aware, the CRR reduction would be carried out in 4 phases of 25 basis points, each of which 2 tranches have already become effective, supporting lower funding costs. We expect further COF benefits coming in the next quarters. Coming to the asset side, loan origination remained strong this quarter with the highest disbursements ever of rupees 7,932 crores, up 21% QOQ and 48% YOY. For H126, disbursements grew 36% to 14,471 crores, led by the continued momentum in the secured loan book. Our gross loan book grew 3.9% QOQ and 14% YOY to rupees 34,588 crores, driven by our disciplined approach to diversify asset suite and build a sustainable loan book. This has led to share of secured loans improving to 47%. With the MFIN guardrails now in place, our microfinance portfolio is stabilizing, showing consistent repayment behavior with Bucket X collection efficiency improving month on month from 99.46% in July 25 to 99.50% in September 25. In line with our stated branch addition plans, we added 14 branches in Q2. We shall be adding 11 branches in H2 26 to expand our network. These branches will start offering microbanking asset products from day one, while other products will be rolled out in due course of time. In Q2 26, we added roughly 1.26 lakh customers in the microbanking segment and have witnessed a graduation of approximately 32,000 group loan customers to individual loans. The graduation of MB customers to secured products lines such as gold loans, vehicle finance, and micro-mortgages also bodes well for the bank. Moving on to specific asset updates. It is heartening to inform that microbanking has grown meaningfully during Q2 26 by Rs 277 crores, which is 1.5% of June 25 base. The group loan book stood at Rs 13,106 crores, registering a growth of 1.1% QOQ, backed by a quarterly disbursement of Rs 3,131 crores in Q2 26, up 29.5% YOY and 10.1% QOQ. On individual loans, gross loan book remains strong at Rs 5,464 crores, registering 9.3% YOY and 2.5% QOQ. Disbursements for IL in Q2 26 stood at Rs 1,128 crores, up 3.5% QOQ. The growth in secured book is well aligned with our long-term vision of increasing its share, and this grew by 52.9% YOY in Q2 26. We have already grown 15.6% in H1 and are on track to meet the FY26 guidance of 35% plus secured book growth. This was on the back of strong growth from the affordable housing and micro-mortgage loan book, supported by MSME and other emerging products with gold loans, vehicle finance, and agri loans. Secured disbursements in Q2 26 came in at Rs 3,701 crores, growing 78.8% YOY and 39.6% QOQ. AHL and micro-mortgages. Our housing book remains well balanced between salaried and self-employed customers and has around 94% of loans availed for self-occupied homes. Affordable housing loans delivered strong growth with a gross loan book of Rs 7,656 crores, up 42% YOY and 8.3% QOQ. Micro-mortgages continued upward trajectory with gross loan book coming in at Rs 1,094 crores, up 180% YOY and 23% QOQ. Our GNPA on the housing book has been steady around 1.1% for last 4 quarters, reflecting stability in the loan book. MSME. During the year, the SME business scaled up meaningfully with the loan book touching Rs 2,559 crores, a growth of 69% YOY and 14% QOQ. Working capital and supply chain finance now comprise over 23% of the loan book, thus reflecting diversification and deeper customer engagement. Gold loans. Our gold loan business improved its monthly disbursement run rate to Rs 72 crores in the quarter. Our gold loan offerings have expanded to 326 branches to be further scaled up to 400 branches in financial year 26. The gross loan book stood at Rs 412 crores, growing 6x over Q2 25 and registering a robust sequential growth of 41% QOQ. Agri loans are now available across 298 branches aimed at supporting individual borrowers, farmers. The gross loan book has scaled up to Rs 510 crores in Q2 26, growing 4x YOY and strong sequential 27%. Vehicle loans are now available in 262 branches with focus on funding new two-wheelers. In Q226, gross loan book grew to 656 crores, up 150% YOY and 17% QOQ. Disbursements stayed healthy at rupees 165 crore with a robust growth of 117% YOY. We expect strong demand for two-wheeler loans in Q326 on the back of festivals across geographies. On asset quality, the slippages have started to reduce and came in at rupees 278 crores after staying at approximate levels of rupees 350 crore for each of the previous 3 quarters. I am delighted to share that our SMA book as of September 25 is below 2%, reflecting the lowest level since Q1 25. This drop is driven by improvement in the MB segment. As anticipated, credit cost for the quarter came in at rupees 235 crores. We anticipate a meaningful decline in credit cost in the second half. Bank undertook rupees 31 crores of accelerated provision in Q226 and maintained PCR at 73%. Additionally, rupees 21 crore of floating provision is available as part of other provisions. The lower ticket secured segment is being closely watched and due prudence is being exercised to have a tight control over quality. As of now, we do not see any aberrations in these segments. Secured vertical slippage stayed nearly constant at around rupees 50 crore for 6 consecutive quarters. On our financial performance, net interest income stood at rupees 922 crores, expanding by rupees 65.7 crores QOQ. Other income got boost due to higher disbursements and increased insurance penetration. While we reported a steady rupees 256 crores other income for the quarter, the share of processing fee and insurance products was 53% compared to 40% in Q1 26. This segment will continue to improve and contribute to total income. Net interest margin in Q2 26 came in higher at 7.9% versus 7.7% in Q1 26, supported by utilization of liquidity buffers. Loan book yields were at 17.5% versus 17.6% in Q1 26 with an increased share of the secured mix. We expect NIM to stabilize around these levels for the financial year 26. Cost to income remained stable sequentially at 66.4%. PAT for the quarter stood at 122 crore with ROA at 1% and ROE at 7.7%, reflecting gradual improvement. Capital position remains strong with CRAR at 21.4% and is aligned with our planned book growth. In the end, I would like to add that bank continues to critically evaluate and improve its OPEX and finance cost controls while looking to expand productivity, efficiency to support the future growth. Before I conclude, I would like to introduce Mr. Deepak Agarwal, who has joined as our Head of Strategy and Transformation. He has in the past driven strategy formulation, large-scale transformations, and business outcomes in various organizations. He last held the position of Head of Retail Business Strategy at Axis Bank and previously worked with MasterCard, Deloitte, and KPMG. Thank you, and I hand over back to Mark for the Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, we request you to limit your questions to 2 questions per participant. In case of follow-up, please rejoin the queue. The first question is from the line of Renish from ICICI Securities. Please go ahead.
Yeah, hi sir, and congrats on a good set of numbers. Sir, just two things from my side. One on this non-microbanking profitability piece. So when we look at the yields, which has been static at around 12% for last 4-5 quarters, despite introducing new products like micro lab, vehicle, etc. Though the base is very low, I can understand that. But at 12% yield, I'm sure this the entire non-microbanking piece. Yeah.
Renish, sorry, can you please just check your line? We are not able to hear you clearly. Could you please repeat the question?
Is it better now? Hello?
Yes,
Yeah. So my first question is on this non-microbanking profitability piece, right? So when we look at the non-microbanking yields, which are at flat 12% for last 4-5 quarters, and at this yield, I'm sure non-microbanking vertical would be not even break-even. So what is the strategy here, in non-microbanking piece? I can understand that we have introduced many new products like microlab, vehicle, etc., which is yielding 19-20%. But broadly, when do you see this entire non-microbanking piece start contributing to at least PPOP level?
Hi, Renish.
Yeah, hi, sir.
Can you hear me?
Yes, sir.
So as you know, I'll answer in 2-3 parts. First is regarding housing. Housing already making decent amount of money, and it's been around for 7 to 8 years. So they are making enough money, and we need to scale it up further. Now, next is gold. It's a new product, and by next year, we should be in a position to definitely break even there and make some money. Coming to, two-wheeler. Two-wheeler is going to end up with around 1,000 crore book this year. Once it is 1,000 crore by end of this year, we should be breaking even in two-wheeler. Micro mortgage has already broken even. So from that, you will make money going forward. So MSME is almost in break-even stage. I think by end of this year, MSME also will come into shape. Yeah. Supply chain is already in profit. Working capital will break even. Yes.
And any further data would you like to share? Let's say mortgage, I can understand it would be profit-making since it's one of the oldest products. But is it fair to assume that the profitability currently would be less than 2% ROA at product level?
We don't want to go into the detailed ROE at this stage, and ROA, sorry.
Okay.
But yes, it will come to the industry level within next 2-3 years. That's what we are planning. We are not there still. If you look at the industry level comparison, benchmark, we will be there in next 2-3 years. That's what is our plan.
Got it. And again, sir, a related question on the vehicle financing piece, which is dominantly two-wheeler currently. And I'm surprised to see that given it's a new product, despite that our gross NPA is touching 2%, PAR is 5%. So what is happening in that portfolio? I mean, despite this book not seasoning, the gross NPA is already inching up. So are we changing any strategy, product mix here, or what is happening?
Renish, in vehicle finance, yes, it is a 18-month-old product. Our GNPA of last year book is where the GNPA has come from. And even on a 12-month book, the GNPA has not crossed 2.5%. So it is moving in the right direction. There is not much bump up in GNPA we have seen in the last 6 months specifically. There is some part of the GNPA which was pre-2023 book, 2024 book, which these were locations which we have discontinued. So there is some amount of gross NPA there, which is almost about 30-35% of the overall NPA.
Got it. So you're broadly, you're saying new book, let's say 6 months.
Yeah. So, Renish, we look at Bucket X collection efficiency on a month-on-month basis. It's been hovering in the range of 99, 99.1, 98.9 consistently for the last 9 to 12 months. So Bucket X collection efficiency being steady and Bucket 1 to 90 being steady in the range of 60-50%, there is, increase in slippages is not visible.
Got it. Okay.
So just to add to that, hi, this is Carol.
To
add to that, our book grew 17% quarter on quarter in vehicle finance, and currently our book size is around 656 crores. We are mainly in the tier 1 and 2 cities, and our metro urban percentages come close to around 75%. So our book is holding up at the moment.
Okay, got it. No, this is very helpful. Best of luck and thank you.
Thank you. The next question is from the line of Digant Haria from Greenedge Wealth. Please go ahead.
Yeah, thank you for the opportunity. My question is on the microfinance piece. I see that, we've started growing the loan book as well, and it's reflective in our net interest income, yields, everything. So just wanted to check here that, because you are the most diversified microfinance player, so, what are the trends you are seeing that, are more and more districts becoming, so to say, lendable, that, where you can go out and source new books? Or is it more like, player dependent that, in some districts we may find growth opportunities, but other may not? If you can just highlight what do you see on the ground?
So, Digant, like we've been discussing in the last 2-3 earnings calls, there was significant stress in the group loan book. And we had called out that there was stress in Gujarat, Tamil Nadu, and Karnataka got added in Q4 of this financial year. And therefore, the slippages that we were seeing were largely from these three. And we had also mentioned that there are some smaller states where we were not focused, for example, Kerala and Odisha. In most of the other states, the slippages had peaked out in March, and Karnataka also came back to normalcy. What we are now seeing on the ground is most of the districts are doing fine. Tamil Nadu has started to show 99.5% efficiency. Karnataka is coming close to that. And states in East are doing well, with the exception of Odisha. States in West are doing well, with the exception of Gujarat. Gujarat probably will take a quarter or two more. And North has started to grow quite well. So if you ask me about specific areas, there are some specific areas in Gujarat and Karnataka which are still not out of the woods yet. However, we feel that in most of the other parts of the country are quite, ready for growth of the next phase.
Okay, that's really detailed, and thank you. So just let say 12 months from now, the next 12 months, we can think of a 15% kind of a growth in the micro, in this whole, microfinance loan book, JLG plus individual loans.
So, Digant, we can look at H2 as of now. So we have been cautious in our growth in H1 because we were still not sure about whether the stress is going to continue longer. But in Q2, we started getting the confidence that, yes, there is demand coming in from the market. We feel that H2 will be much, much better than H1 in terms of both disbursement and growth. We see for the full financial year a growth of about 7 to 8% on the microbanking book.
All right, fine. And the last question is on our credit cost. I think that has also started declining. So that flow, we know that flow has reduced. That we know since the last 2 quarters that flow has been reducing. But at least the stock, we are almost getting done on the provisions on the stock as well.
In terms of provisions, we had also said that, look, Q1 and Q2 are going to be elevated because there was a NPA addition happening in Q4 and Q1. And over a period of time, the provisions would start to taper off. And you will start seeing this trend in Q3 and Q4 because provisions for most of the book has been done. There is a tail left which will get covered in Q3 and Q4.
Okay. All right, sir. Thank you so much. I wish you all the best, and kudos to your team for being almost the first one to recover from this whole last 1.5 year of stress. Congratulations. Thank you.
Thank you, Devang.
Thank you. The next question is from the line of Suraj Das from Sundaram Mutual Funds. Over to you.
Am I audible?
Yes, sir.
Yes, Suraj. We can't hear you, Suraj.
So, requesting you to please unmute your mic.
Can you hear me now?
Yes, you are audible, sir.
Go ahead. Okay, sure. So, the question is, sir, on the individual loan book, on the individual MFI loan book, if you look at the PAR numbers, especially in Maharashtra, I think that number is slightly inching up. So, is there anything to read into it in terms of how do you look at the number? Well, the group loan is doing well, but I think Maharashtra PAR 0, PAR 30, even PAR 90 on the individual portfolio is inching up for last 4 quarters, 3-4 quarters.
Not much to read if you look at it, Suraj. The NPA remains at below 2%, and the PAR is in the range of 4%. Is the PAR looking elevated at this time? Yes, compared to group loans, it is looking slightly elevated. But, in individual loans, the collection efficiency as well as the flow to NPA is slightly slower as compared to group loans because a lot of collection happens in SMA 0, 1 and 2. So, in terms of slippages, this trend is showing up consistently for 3 or 4 quarters. We don't see any incremental stress in Maharashtra in individual loans.
Okay. So currently, I think that number is 5.5, which was 3.5 2 quarters back. You think that number will, let us say, normalize in couple of quarters because of this collection thing?
In Maharashtra, the overall PAR is 4.2 and the NPA is 1.9. So the SMA book is about 2.3.
On the individual portfolio specifically, I was asking Ashish.
Yes, this is for the individual portfolio. Overall PAR of 4.2 and GNP of 1.9.
Okay, sure. So that is part one. Second question was more on the risk weight side. So if I look at the risk weight number, that has gone up by 9% QOQ versus 4% loan growth. So anything to read? I mean, what is the rationale here? Because your MFI has not grown in that sense. Your overall growth was 4% versus MFI is 2% QOQ. While your MSME and affordable housing has grown higher than the overall growth. But those are, I think, housing and LAP loans, right? So what is the rationale of RWA growing faster than the loan growth?
Hi, Suraj, Brijesh here. In this quarter, where the RWA and the risk weight was come down by 141 bips. Out of that, 55 bips was mostly contributed from some of the operational aspects like off-balance sheet adjustments, some rating related to our institutional borrowers, which will reflect over the time. So it will get automatically adjusted. So effective RWA utilization was 86 bips, which is commensurate with our loan growth of around 1,300 crores. So we expect the RWA to remain at similar level, looking at the estimated loan growth as well as the profitability. And the PAT accrual, which estimated PAT accrual for the next 2 quarters.
Sure. Understood. Yeah, I think those are my 2 questions. Thanks.
Thank you. The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Hi. Congratulations on good numbers. My first question is on the collection efficiency in September at the bank level has seen a good uptick on a month-on-month basis. And I believe there is no seasonality at play because last year there was no such uptick in September versus August. So is there something to read into in terms of can it be a sustainable trend for Q3, Q4, or is it a function that you were able to, recover a lot of overdues, in the month of September? Can you just comment whether the September uptake is sustainable in the coming months?
Rajiv, the collection efficiency that you see increasing from 97.2 to 98, this, is a weighted average of non-delinquent SMA and NPA book.
Correct.
So as the NPA book starts to slow down, the weighted average collection efficiency is expected to improve going forward also.
But any color on whether the SMA collections in micro banking in particular, where you have a larger 1 to 90 DPD pool, is also improving given the effort that we put, to ensure that that pool doesn't roll forward.
Yes, Rajiv. In fact, that was the strategy for Q1, and we had discussed it in the past that, look, when delinquencies start to go up, the best pools to focus are 1 to 90 and 91 to 180 because that is where the incremental slippages would happen. And therefore, to manage stress, what we had done was over-managing collections in SMA and early NPA book 91 to 180. And the collection efficiencies have been very good in our SMA book. That is reflecting in our improved slippages.
Mm-hmm. Okay, my second question is on margins, and you've given the outlook that margins will remain, broadly similar in second half. So, my question firstly is on yield side. When I look at your micro banking yield, it's flat. But in the previous quarter, you had that 14 bips of one-off impact. So we have not seen an expansion because of that absence. And plus, the slippages were also lower in this quarter. Disbursements are going strong. So the question is, where did the micro banking yield improve on Q-on-Q basis? And second is on the deposit side. When you look at the average bulk deposit pricing right now versus the prevailing market rates, is there any scope for further downward repricing? And on the retail term deposits, I see a sharp decline in the absolute deposit base. So how do we manage the traction of retail term deposits given that we want to grow at 20% at the bank level and, that is the biggest pool of deposit for us?
So Rajiv, if you see the NIM has improved by 20 basis points, coming at 7.90%. Our micro mortgages book is growing strong. The micro banking has just about beginning to spread its wings, coming back into the growth trajectory. The vehicle finance has been doing well. It is a high yielding book, and the housing side also has, for the last 2 quarters, shown improvement and has maintained the higher yield than it was maintaining in the previous 2 quarters or so. So overall, what we are seeing is that the yield on our portfolio is actually maintaining itself. Of course, the repo cut notwithstanding, and the repo cut is actually applicable to only 17% of our book, which is MSME, which is on repo rate, and the FIG partial book of which is on repo rates. So I think the cost of deposits that the steps that we took from April to August are only now beginning to show their effect. The September quarter saw only the major impact that we did in the month of August. Only a partial effect of that has flown into this quarter. The coming quarter, we are likely to see a better cost of deposits coming into our books, and therefore we feel that the NIMs at around 7.90 thereabouts is very much possible, is very much on the cards for our bank. Hope this addresses your issue.
No, sir, clear about that. I had specific, question on why the microbanking yield did not improve Q on Q. Second was, how do we manage the retail term deposit traction? Would we need to, start not cut, pricing aggressively here, because the absolute deposits have fallen pretty sharply, and we are also aspiring for, much higher levels of growth, so we'll require those deposits to flow in for us. So in that context, growth versus margins, that's the whole, paradox. Yeah.
Okay. So that on the term deposit side, as we explained in the last call, we had a gush of liquidity sitting on our books, and in this quarter we flushed out the liquidity, because of which the CASA was focused upon, and therefore the kind of growth that we had and the room that we had over the CD ratio, because we were at 85 or 86% in the previous quarter, we had enough room to grow our loans on the existing set of deposits. So it was a pure play on not taking high cost deposits and managing with the existing liquidity that we had, and also simultaneously flushing out the excess liquidity that was sitting inside. Of course, now we are seeing the growth coming back, because that's the way we have modulated our team members, and therefore there is no challenge, there is no hiccup. It was a conscious call to actually be flexible in terms of the situation in which we were. So term deposits is all about that, and we are seeing the growth coming back, because that's how we are now playing our game. And on the microfinance side, please. Yeah.
Sorry. Okay. Now, regarding microbanking yield, what you are asking, it is stable at 22%. We have not changed any rates, so we assume till the year end it will continue to be the same. Okay, now over to Mr. Hitendra. He'll answer on the deposit.
So on bulk TD and retail TD, we had an opportunity to source bulk TD at lower rate. We had almost 67 bips lower than a retail TD, so we focused slightly on a bulk TD. However, focus continues to retail TD. And also, if you look at maturity versus sourcing, we had almost a benefit of 1.08 bips, 108 bips on a sourcing side, maturity sourcing side on retail side. So retail TD, we can scale up whenever we want. It was a strategic call. It was not something which we had not anticipated.
No, this is clear. Thank you. Best of luck.
Thank you. The next question is from the line of Abhishek Murarka from HSBC. Please go ahead. Sir Abhishek, please put your line on unmute.
Hello, am I audible?
Yes, sir, you're
Hello?
audible.
Yes, Abhishek.
Yeah. Hi. Congratulations for the quarter. Just picking up from Suraj's question, actually, if you see the IL PAR, in 2 or 3 states, it has gone up, right? I think in Karnataka, Maharashtra, West Bengal, it has gone up. And the thing is that the weighted average looks good because, in the other states you're doing okay. But any risk that you see in IL, especially in the context that, over the medium to long term, you want to increase it from 30% of the book to 45% or so. So any early learnings or anything from these 3 states, or what's the real reason for this PAR going up in the IL portfolio?
Abhishek, PAR has gone. There are only 2 states which for the last 3 quarters have not shown a better PAR or a better NPA behavior. One of them is Karnataka, which, as we all know, had external issues. So therefore the PAR was elevated. Otherwise, Karnataka always had a NPA below 2%. Currently, the NPA is about 4.8% and PAR is about 7.4%. So it is an external reason. There are two other states where PAR and NPA have not shown a significant improvement. One is West Bengal and the second is Bihar, which you're not seeing in the top 5 states. It's a smaller state for us. So in West Bengal, we have, kind of being calibrated in our growth. We have not been growing much. And in Bihar, we have actually seen a flat book growth. So it's not been increasing again. Our focus areas have been Maharashtra, Tamil Nadu, Haryana, and these are the areas which are doing well for us. Nothing in terms of the product construct or the underwriting or the income levels of the people. It is, I would say, related to Karnataka or West Bengal or Bihar. It is more like, geographic areas not showing improvement as against the product construct or the income assessment.
Okay, so you're not feeling compelled to modify any of these, any features of the product or underwriting based on what you found in Bengal or Bihar, or even Maharashtra. Your numbers from 1Q versus this is actually deteriorated a little bit. The PAR 30 and the PAR 90.
Yeah, some little bit of improvement, deterioration, we can keep seeing over a quarter on quarter, but not much to read in terms of the asset quality per se. There are only two areas which, as I said, West Bengal and Bihar, where we are not seeing any growth as well. It is a flat book growth.
Okay, fine. And in terms of your overall credit cost, your full year guidance of 2.3, 2.4 remains. But your first half, even if I remove the, the accelerated provision, it's around 270 bips. So second half should be around 210 bips or lower. Is that something you are envisaging? And where is that improvement? So GL, of course, but are all the write-offs pretty much over in GL? Can you give some sense on how you expect to achieve this 2.4?
So as we said, we are not changing our guidance on credit cost. It will be in the range of 2.4. And H2 is going to be better than H1. That's again something that we had told in the last call as well, because the bucket provisions were seen in the first half as compared to the second half. In terms of write-offs, H2 write-offs are going to be significantly lower. Most of the write-offs that we have done, over in the entire write-off pool that we have done, I think only 2 crore comes from vehicle finance. Everything else comes from micro-banking only. And H2, I think the same trend will continue. Much lower write-offs and mostly from micro-banking.
Okay. How much of the PAR 90 pool do you expect to write off now in MFI?
See, the write-offs normally happen when there is a full provision taken on any account. So, very difficult to say what percentage will be written off. But you can take a thumb rule of about 1.2 to 1.3% for the second half.
From the GL PAR 90? Out of the GL PAR 90?
From the total micro banking, not GL.
Okay, from the total micro banking. Okay.
That's right.
Got it. Okay, thank you. That was my question. Thank you, and all the best.
Thank you. The next question is from the line of Shripal Doshi from Equirus. Please go ahead.
Hi, thank you for giving me the opportunity and congrats to the entire team for a good quarter. My question was, firstly, if you recall, like the last couple of quarters, we've also seen issues pertaining to attrition as one of the reasons for elevated credit costs or even collection efficiencies being impacted. How has that trend shaped up, let's say in the last quarter, and what are we doing in terms of measures to curtail it, particularly the lower level attritions?
Hi, Shripal. See, from the attrition perspective, we have everything under control, and we are not seeing any kind of reasons why we need to worry on the attrition front. It is flat from the last quarter. And,
so
we are taking care of our employees as usual.
So what is it like at current levels at loan officer level or lower hierarchy level?
Yeah, we are at an annualized attrition rate of around 20% now.
Okay. In any particular states where it would be elevated or where the issues are more prominent?
We are not seeing anything particularly, but it's sort of flattish.
Got it. The other question was on the disbursement side. So post the implementation of guardrails, what are the disbursement ticket size for new GL customers, as well as what are the ticket size for the customers that we moved up from, let's say, GL to IL category? That's the second question that I had on the ticket size for these two post the, let's say, guardrail being implemented, where you don't have more than 3 lenders to a particular customer.
Our group loan ticket size is hovering around close to 64,000, and GL to IL graduation, so IL ticket size is almost constant at close to 1.3 lakh for last 2-3 quarters.
So that would be the average number, and what would be the range basically for the, let's say, relatively vintage customer in GL? We go up to 80,000, or is it more than that now?
We go, as per policy, we go up to 1.25 lakh, but for customers who are third cycle and above, the average ticket size is close to 80,000.
Okay. And in the IL category?
IL category, average, as I mentioned, it is 1.3 lakh. The customers who go to higher, cycles, the average ticket size move up to close to 1.5, 1.6.
Okay. And what will be the higher range here? Like, let's say the bracket in terms of the higher bracket.
IL, the higher. Yeah. So as GL, it is up to 1.25 lakh. In IL, the highest ticket size possible is 3 lakh.
Got it. And in IL, just one last question here. Do we really monitor the end use being business, or is it not closely monitored?
So both GL and IL are purpose-based loans. IL, we have various purposes, including business loan, livestock loan, home improvement loan. And similarly, in GL also, it is purpose-driven loan, and LUC is done 100% for all the loans. And based on that, only the PSL classification happens. So LUC happens for all cases by a bank employee.
Got it. The last question was pertaining to a data point. Could you please give out that CD book number, because it's not given in the presentation.
Asking about TD book, you're saying?
CD, certificate of deposit.
CD. It is 411 crores.
All right. Thank you so much, and good luck for the next quarter.
Thank you. Thank you. The next question is from the line of Shailesh Kanani from Centrum Broking. Please go ahead.
Yeah, good evening, and thanks for the opportunity. So I just wanted to understand, in terms of book mix, this year maybe we'll end up somewhere between 50-50 in terms of micro banking and non-micro banking, given the growth. What would be a comfortable range in medium to long term, and how should we see that for FY27-28?
Shailesh, as part of our 5-year strategy, we have contemplated that our secured book would be in the region of 65 to 70%, and the remaining would be the unsecured part. So as we go along each year, the proportion of the secured book will continue to grow faster than the unsecured part.
Okay.
Hope this is okay.
Yeah, that's fine. And second question was with respect to our return of pool. What would be that amount? And also in terms of recovery from that bad debts, if you can give some color, how can we expect that, because that pool is on the higher side?
So the pool that we have, there are two pools here. One is the written off pool, which we have written off post-COVID, and there is a sale of assets that we had done. Put together, this is about 750 odd crores, and we expect anything between 15 to 20% recovery from this pool during this financial year.
So 150 odd crores, you are saying 15 to 20% out of that?
That's right.
So my third question was with respect to our second half performance.
Sorry to interrupt.
Yeah.
Due to time constraint, I request you to please rejoin the queue.
Sure. Thanks.
Thank you. The next question is from the line of Ashilesh Sonji from Kotak Securities. Requesting participants to limit the questions to one per participant. Thank you.
Provision coverage which you have specifically for microfinance, including any NPA.
Sorry to interrupt. So could you please reconfirm your question?
Hi, just one question on MFI. If you can share the provisions which you are carrying specifically for microfinance, including NPA provision as well as any other provision buffers which you have. And secondly, if you can just explain this additional slide which you have added on page number 22 of the presentation, the line chart which you have added.
Okay, in terms of PCR, Ashlesh, we have 80% provisioning cover on micro banking.
Any other standard asset or contingent provisions there along with that?
Standard asset. So standard asset is about 0.5% that we keep on all the standard assets.
Okay, got it.
On your question on the slide, this is nothing but, after Guardrail 2.0 implementation in April, we were just trying to show that, as per, MFIN guideline also, loans cannot be given to customers who are 60 DPD, though in Ujjivan we follow 30 DPD, it is stringent compared to what MFIN guideline says. But internally also we have guideline around customers' credit behavior, and based on that we accept or reject loans. So internally, based on customer repayment history, if customers are up to 30 DPD and between 30 to 60 DPD, we can still lend. But what trend shows that in the last 5 quarters, the percentage of loans which is going to customers who are ever 30 to 60 DPD in their previous cycle, the percentage of loan there is below 0.5%, actually much below than 0.5%. That says that we are not encouraging customers who are not having good repayment history in the previous cycle.
Understood, sir. Thank you. Those are all the questions I had.
Thank you. The next question is from the line of Anand Damak from MK Global. Please go ahead.
Yeah, most of my questions are answered. I had one question around the, I think during the analyst meet you had suggested that you had exposure to microfinance borrowers who in turn had were employees of the Tirupur-based textile corporates. Any stress that you have seen in that portfolio? I think that was about 2% of your overall microfinance portfolio, borrowers as such.
We have not seen any initial trend as of now. In fact, our repayment behavior in the Tirupur belt has not shown any decline. We have been watching Gujarat very closely, We've been watching NCR very closely. We've not seen any decline in the repayment behavior till now.
So then what explains basically the surge that we have seen in the PAR portfolio, particularly in the state of Karnataka? It is still to do with that ordinance, or like there are additional things which have actually happened and because of which the...
Nothing new, Anand. It is actually showing a very good improvement over the last 2 quarters. In fact, we are very close to 99.5% bucket X collection efficiency in microbanking, even in the state of Karnataka. So we have seen improvement in bucket X collection efficiency, improvement in slippages, and the portfolio is coming under control now.
But your PAR portfolio is
an
going
external
up,
event, which is largely over,
So that is basically the fresh stress. So, but yeah, the problem is that your PAR portfolio is still going up, right? And that could keep the credit cost higher in the state of Karnataka. And then you have Bihar elections now, and then maybe West Bengal elections next year.
So, Anand, if you look at it in terms of SMA bucket, early NPA and late NPA, the portfolio in Karnataka, which had gone into delinquency post the ordinance, that had to, go through collections as well as recognition of NPA both ways and credit cost. But, in the last earnings call, we said that 33% of our incremental slippages in the quarter were coming in from Karnataka because Karnataka was going through a lot of pain. This quarter, we have seen that number coming below 20%. So there is a significant improvement in Karnataka portfolio. The early delinquency has more or less come back to normalcy. There is a NPA recognition and credit cost recognition which will happen during these 2 or 3 quarters, Q2, Q3, Q4. And I think by then things will come back to normal.
Lastly, that we expect a universal bank license to come through. Any additional OPEX that we are already incurring in run-up to that license, or how should we look at the overall OPEX growth or OPEX ratios in FY26 and FY27?
Anand, our application is with the Reserve Bank of India, and they are evaluating and assessing our application, its contents. So the matter rests there. As we said earlier, we will await the decision of the RBI. And as far as expenses or additional expenditure that we will need to do, I think nothing changes immediately as we become a universal bank. Of course, there will be some matters which will gain immediate attention. That will be about signages, our email addresses, our, all those kinds of letterheads. So those will be taken care of once we, get a positive decision from the Reserve Bank of India. And the other expenses or the investments that we will do are part of the general strategy that we have chalked out, which is agnostic to any outcome that we may get from Reserve Bank of India. So not much expenditure, if at all there is. Yes, there will be some, but it is nothing of note or of materiality. Trust this is okay.
Lastly, if possible, if you allow me, basically just wanted to check.
Sorry to interrupt.
Impact that you have.
Sir, due to time restraints, I request you to please rejoin the queue.
Sure, sir.
Requesting participants to limit their questions to 1 question per participant. Thank you. The next question is from the line of Abhishek Tandon from Bowhead, India. Please go ahead.
Yeah, hi. Thanks for the opportunity. So just a question on credit cost. Going into fiscal 27, your secured book obviously will keep increasing. And I guess there the credit costs are pretty low because big parts of the secured book is affordable housing and FIG, where I guess you have very low credit costs. And microfinance would also be on a strong footing in fiscal 27. So is the assumption of, say, a credit cost of 1% in fiscal 27 a very aggressive assumption, would you say?
So, Abhishek, we'll come back on that, whether we want to take any assumptions for FY27 as of now. But what we can surely see is the credit costs, this cycle would not extend beyond Q4 of this year. And therefore, we'll see much better normalcy in the next financial year. I would also like to add here that we have started monitoring the book that we have sourced in the last 12 months, and it is showing much better quality than the one which we had previous to that.
Okay, thank you so much.
Thank you. The next question is from the line of Sagar Shah from Spark PWM. Please go ahead.
Yeah. First of all, thank you for the opportunity and good evening and congratulations to the management for showing such a resilient set of numbers actually in such an environment. So my one question, sir, would be in terms of IL loans, individual loans. Individual loans as compared to the March 24 year ending, actually they have been relatively on the flat side. So means I'm talking of the IL loans. IL loans have been shown very negligible growth actually. So my question is that considering that we are nearing to the bottom of this crisis, a micro banking crisis, and you would have got filtered out some good quality GL customers also after the 1 year debacle actually. So is it safe to assume in the next 6 months, in the next 2 quarters, our IL growth actually will grow better actually than the obviously the GL growth due to the better filterment of the GL customers, and will we get such good quality customers, and what are you seeing on ground actually?
So, IL definitely, IL has been our growth engine in microfinance in the last 3-4 years, and we want to grow this business. IL is mostly, for us, it is GL to IL graduation, though we focus a little bit on open market acquisition as well. When we started this year, at that point of time, the industry was still going through a crisis, and further fueled by Karnataka issue as well. We were a little slower and cautious in the first quarter. Though IL has done better than GL in terms of growth in the first 2 quarters of the year. But yes, going forward in next 2 quarters, you will see IL doing much better than GL, and overall in absolute values as well. As you rightly mentioned that we have good customers where the repayment history has been excellent, their income levels are high and eligible for graduation. So in this next 2 quarters, you will see IL doing better than what we have done in the first 2 quarters.
Okay, I got the answer. Thank you so much, sir, and happy Diwali and best of luck for the next quarters.
Same to you.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good evening, sir, and congratulations on a good set of numbers. So most of the questions have been answered. So just one question on the cost of funds. So we have seen a 30 basis point decline in this quarter from previous quarter. And how do you see this going forward? Are there some levels because of which we will be able to reduce it, or given that we have done high consumption in this on CD, so going forward we'll be sort of increasing the rates again to capture more of this for our high growth ambition on the advances side?
Yeah, hi Sarvesh. So we had taken rate cuts in both FDs and also savings account between April to August, and we have seen some of the benefits flowing in the second quarter. We expect further benefits to flow in as the repricing happens for the fixed deposits. So those benefits will keep coming, and we expect to see better numbers in the next 2 quarters.
But where do you want Yeah, sorry, go ahead.
Sorry, please carry on.
Yeah, basically, where do you expect this sort of a number to settle down eventually?
What we cannot, it's very difficult to give exact number, but what we are saying, TD repricing will happen, so cost of fund will go down from here. The SAR repricing has happened, so SAR book is already repriced, okay? Cost of fund has come down there. TD, as we go along, whatever incremental TD is booking, they're booking at much lower cost.
Okay.
Yeah, so So we are sourcing at roughly 7.38% now, TD. Average cost.
Understood.
So just to conclude, we expect to end off the year with around 7.1%, something like that. Yeah.
Around 7.1, yeah, right.
Okay. And sir, on the secured book side, so your yield is around 12%. How do you see this increasing, or do you think that this is what it can achieve? Because we are adding the other products which have got higher yields. But overall, how do you see the non-microfinance book yields behaving in the coming quarters or years?
So the non-micro banking yields will go up a bit because of the newer segments which we have launched, which are higher yielding, like micro mortgage around 19% plus, gold loans in the range of 15%, vehicle loans in the range of 20%. And with the contribution increasing in the non-micro banking book, overall the yields for this book is expected to, go a little upwards.
Any number that you would want to reach there?
No, it's difficult to put a number to this. It depends on the book mix and how the products perform. So maybe here and there, but a little uptick should happen.
Okay. Thank you, sir. All the best.
Thank you. The last question is from the line of Ashok Daga from Retail Investor. Please go ahead.
Hello, I am audible?
Yes, you are, sir.
Yes, please.
Yes, sir. So my question is that this last 4 quarters, what I am seeing, you from your financing, that is your main business, you are incurring a loss continuously. So what was the reason and how you are going to control that? And due to this, even though you are showing your net profit is a positive due to other income, but your main business is showing the negative portion. So how this your cost of fund or all these things is going to make or bring you in the positive area?
Sorry, could you please repeat the question, sir?
My question is that your financial means whatever your cost, your deposit and interest you are paying as your expenses are there. From that last 4 quarters you are showing a loss. Your profit is coming from the other income. Due to that your net profit is the positive, but your OPM is the negative for the last continuous 4 quarters. My question is clear or I require more elaboration?
No, so we are not able to understand the question, sir. We'll connect off with you offline and maybe take this question, sir. While I just want to highlight to you is that our pre-provision operating profits have been, have been coming across, and they have started to grow sequentially as of now.
Okay, so
yeah, but we'll connect with you and take it offline as well.
Yeah. Okay, thank you.
Thank you. Ladies and gentlemen, that was the last question for the day. I now hand over the conference over to the MD for the closing comments.
I once again thank all the participants for their time and interest. We at Ujjivan SFB remain focused on delivering on our guided numbers while we build an enduring institution. I wish everybody a happy Deepavali in advance. Please reach out to our IR team for any queries that you may have. Thank you once again.
On behalf of Ujjivan Small Finance Bank Limited, that concludes this conference. Wishing you all a happy Diwali. Thank you for joining us, and you may now disconnect your line.